Welcome back to the deep dive. Today, we're really going to dig into something significant happening in telecom and media. We're talking Comcast's third quarter 2025 results. And look, this isn't just us reading a spreadsheet.
No, definitely not. Our goal here, looking at the materials you provided, is to really unpack this massive strategic pivot. I mean, it's intentional. Comcast is consciously shifting gears. They're moving from, relying almost purely on high-margin broadband towards a future built around convergence. Think bundling, wireless media, the whole ecosystem.
Yeah.
And at the same time, they're placing these huge, expensive bets on theme parks and content. It's a lot.
It is. And if you just glanced at the headline numbers, you'd see this kind of strange financial paradox, right? Consolidated total revenue was down 2.7% year over year, which on the surface sounds a bit concerning.
Right, until you remember the comparison point.
Right.
Last year had that huge boost from the Paris Olympics. So if you adjust for that, revenue was actually up almost 3%. But honestly, the really crucial insight here isn't about that top-line growth right now. It's about how they're managing stability while making these radical investments.
Okay, so stability like?
We'll look at Adjusted EBITDA and Adjusted EPS. They stayed remarkably consistent, pretty much flat year over year. That tells you the fundamental business is pretty sound, even as they're funding this big transformation.
Yeah.
And that funding ability, you see it clearly in the free cash flow. It surged 45% to a massive $4.9 billion just in the quarter. That cash, that's the fuel. That's what's powering this whole strategic repositioning.
Okay, so let's unpack this transformation blueprint. And it makes sense to start right at the very top, because the strategy isn't just talk. It's backed by some major, very intentional changes in the executive suite.
Absolutely. The leadership shifts they announced this quarter. They're not just random moves. They really signal an intentional inflection point kind of leadership change. It's designed specifically to navigate this industry shift. You've got Mike Cavanaugh being elevated to co-CEO. That signals continuity at the very highest level while they execute this, frankly, aggressive plan.
And the change feels particularly critical on the connectivity side, right? That's where the main competitive fight is happening daily.
Exactly. Dave Watson, who's really been the driving force in connectivity for, 8 years now?
Yeah.
He's stepping up. He'll become vice chairman of Comcast Corporation effective early 2026. And that basically clears the path for Steve Croney. He's being elevated to CEO of the connectivity and platforms business, taking over from Watson then.
And what's really interesting there is Croney's background. He's not an outsider. He's been driving the very changes we're about to talk about.
That's the key thing for you, the listener, to understand. Croney is the insider, the leader who's been implementing these complex shifts, things like pricing simplicity, the customer experience changes over the last year. That was him. So this transition, it's less about changing course and more about putting the power behind the person best positioned to execute these, frankly, painful short-term moves they think are necessary to secure that long-term customer base.
Okay, that perfectly sets the stage for the big challenge. This intensely competitive broadband landscape, the source materials are crystal clear. This pressure isn't going away anytime soon. It seems quite durable.
It's the new normal, really. Comcast basically expects the market to settle out. You'll likely have most addresses served by 2 main multi-gig symmetrical providers, and they fully intend to be one of those 2. And then the rest will be served by capacity-limited alternatives. Think fixed wireless access, FWA mainly. Fiber expansion, it's continuing steadily. They anticipate most of their current footprint will eventually get overbuilt by fiber. And FWA, that remains a persistent competitor, especially for the more price-sensitive customers out there.
So, okay, if you can't just wait out the competition, you have to outmaneuver them. And that brings us to their new long-term strategy built on these 3 pillars: network, product, and customer experience. Let's start with the network, because the sheer amount of data their customers are burning through is just staggering.
It's huge. The network strategy revolves around using AI end-to-end for constant performance optimization. Just to give you some context, their broadband-only customers averaged 800 gigabytes of data per month in Q3. That figure is up 9% from just last year. I mean, stop and think about that. Almost a terabyte of data going through a single home connection every month. That kind of volume would have been, almost unimaginable just a decade ago.
Right, and usage like that demands serious hardware on the customer end, which leads us to that detail in the product pillar, the new gear.
Yeah, the new XP10 gateway.
It's really a core piece of this strategy. It's designed to be future-proof, basically. Supports multi-gig symmetrical speeds, handles up to 300 connected devices at once, and crucially, it uses AI to self-optimize the home Wi-Fi in real time. This focus on fast, consistent, controlled Wi-Fi. That's why OpenSignal recently ranked Xfinity top in reliability, download speeds, and streaming in their areas. That's compared against big players like Verizon, T-Mobile, AT&T. Okay, and that network and product focus flows right into the third pillar, customer experience and pricing. And this seems like the most radical move, the thing that really separates the new strategy from the old way of doing things.
It's a huge gamble, really, a bet on transparency and simplicity. They've shifted to a much simpler nationwide pricing model, built around 4 clear speed tiers. But what makes it strategic is the all-inclusive part. The plans now bundle the gateway, unlimited data, Wi-Fi controls, cyber protection, all at a lower, more transparent everyday price. And then they back it with a 1-year or even a 5-year price guarantee. The whole idea is to kill that notorious bill shock, get rid of the complex fees that historically just drove customers away.
That sounds fantastic for the customer, definitely. But that level of simplicity, guaranteed pricing, new hardware, it must come at a pretty steep cost, like a near-term financial hit. How quickly did that transparency actually impact the bottom line?
Oh, it was immediate and substantial. This financial headwind is really the critical story in their connectivity and platforms business, or CMP. Adjusted EBITDA for that whole segment. It declined 3.7% in the third quarter. And look, this wasn't an accident. It's the direct calculated cost of that aggressive pivot you just laid out.
Okay, let's break down that 3.7% decline. The sources seem to point to specific choices driving that pressure.
Yeah, the pressure is kind of twofold. First, it's the increased spending. More investment in customer experience and marketing and in the hardware itself. That customer premises equipment, the CPE like the XP10, that's expensive stuff. Second, and probably most critical, is what they call rate reinvestment, which is basically corporate speak for revenue dilution through pricing simplicity. It means they are deliberately not hiking rates on existing customers. They're eating the cost of upgrades and competitive pricing to try and stop churn, stabilize the base.
And we can see that impact, that dilution, directly in the key metric for broadband performance, right?
Absolutely. Broadband ARPU, that's average revenue per user growth, slowed way down, decelerated to just 2.6%. And that slowdown is expected to continue. They explicitly said they expect ARPU growth to step down even further in Q4. What's more, the current plan? It involves not taking a general rate increase on broadband early next year. So they're intentionally soaking up this cost, giving up potentially billions in guaranteed revenue today, all in the hope of achieving what they call a more durable broadband customer base down the road.
Wow, that is a staggering commitment. Keeping ARPU flat for potentially over a year, especially when fiber competition is heating up and data use is soaring 800 gigs a month, it feels incredibly risky if they don't have any other reliable growth engine humming to offset it. Where's the immediate growth coming from?
That growth is coming almost entirely from wireless. Wireless is the absolute engine fueling this whole convergence play right now. Xfinity Mobile hit a new record high, 414,000 net additions just in Q3. That brings their total close to 9 million lines, which means they've now surpassed 14% penetration of their domestic residential broadband base. Pretty impressive penetration.
The pace is definitely impressive, yeah. But the strategy behind it seems, well, highly aggressive. They're essentially giving the product away, at least initially, just to grab market share.
Yeah, that's the calculated risk they're taking. The core strategy leans heavily on these really compelling introductory offers, specifically that free mobile line for 1 year. And the impact is clear. Nearly half, almost 50% of all the residential postpaid phone lines they added in Q3 were free lines. It's a massive, deliberate investment. The goal is to quickly build that converged customer relationship, get them into the ecosystem.
But is there a good track record for this kind of $0 offer successfully converting huge numbers of customers, converting them into paying relationships, without massive churn once that free year is up?
That is the central strategic question for 2026. It really is. The sources sound optimistic. They state their intention is to convert the majority of these free lines into paying relationships starting in the second half of 2026. Yeah. And if they succeed, that conversion event is expected to provide a, quote, significant tailwind to convergence revenue growth. But to your point, the success of this whole strategic pivot, absorbing all this ARPU pressure today, it absolutely hinges on retaining and monetizing those free lines 2 years from now.
Okay, that definitely sets up a high-stakes situation on the connectivity side.
Let's maybe switch gears now and talk about the content and experiences side of the house, theme parks, studios, media properties. Because here we are seeing some definite, immediate, bright spots that are kind of counterbalancing those connectivity pressures.
Oh, absolutely. The theme park segment is just thriving right now. It's probably the most compelling growth story in the short term. Theme parks revenue grew significantly, up 18.7%, and EBITDA jumped 13.1%. And the big driver, no surprise, the successful opening of Epic Universe down in Orlando back in May 2025.
And what's fascinating, reading the sources, is that Epic Universe isn't just doing well on its own. It seems to be lifting the whole operation there.
Precisely. The new park is acting like an anchor. It's driving higher spending per person and increased attendance across the entirety of Universal Orlando. It really suggests the new park is drawing new types of travelers, maybe people who wouldn't have come before.
Yeah.
And that benefits the existing parks too. It's a halo effect. So their operational focus now, it's making sure that park runs perfectly smoothly, driving up ride capacity, improving operating leverage as they move from that initial opening buzz to more of a steady state over the next year.
Right. Meanwhile, studios also put up strong numbers, revenue up 6.1%.
Yeah, that was really fueled by strong theatrical results. The big standout was Jurassic World Rebirth. That film alone grossed almost $900 million worldwide box office just year to date. And when you zoom out, that pushes the entire Jurassic franchise past a massive $7 billion cumulative total. These are incredibly powerful, durable assets. They provide essential stability,
Definitely. Okay, finally, let's quickly touch on media and Peacock. This has been the area of huge investment and, frankly, huge losses for a while. Are we seeing signs of a turnaround there yet?
We are seeing rapid improvement, yes. Media EBITDA increased a very healthy 28.0%, hitting $832 million. And that was largely driven by streamlining operations and the improving performance of Peacock. Crucially, Peacock's quarterly loss, it improved by $219 million compared to the same period last year. So it landed at a loss of $217 million this quarter. Still a loss, but much, much better.
Okay, that improvement is a big step towards actually making it sustainable. What kept the subscriber base stable, though, especially with price hikes?
Well, subscribers were basically flat at 41 million, but the key metric here is retention. It held steady even after they pushed through that $3 price increase earlier in the year. And the cornerstone, as it always seems to be, is live sports. The new NBA rights are launching, which is huge, and Sunday Night Football just keeps dominating. It's still the #1 primetime show 14 straight years now, averaging around 25 million viewers. And that recent NBA season tip-off, it drew the largest audience for an NBA opening doubleheader since way back in 2010, these exclusive live events. They're proving to be the essential glue, the anti-churn tool for the streaming service.
So, okay, to wrap this all up, to summarize the big picture for you, the listener, Comcast is deep in executing this really comprehensive, high-cost strategic shift. They are knowingly accepting short-term financial pain in their core connectivity business, that 3.7% EBITDA dip, the slowing ARPU growth, in exchange for what they hope will be long-term customer stability and durability.
Yeah, they're essentially betting that this aggressive convergence strategy, driven by giving away tons of wireless lines, initially combined with the proven strength of their unique assets.
Yeah.
The global draw of the theme parks, the must-see TV aspect of live sports, that this combination will fundamentally change the customer relationship, moving it from just a transactional utility bill to a much stickier ecosystem relationship.
Right. So the big strategic question for you to think about is purely about the timing and, well, the effectiveness of that payoff, the immediate cost, the pain point of this pivot, the ARPU dilution, the EBITDA pressure, that's clear. It's verifiable right now.
The payoff, though, that hinges entirely on how successful they actually are in converting those millions of free wireless lines, turning them into revenue-generating, paying customers starting in the second half of 2026. That's the whole ballgame for this strategy.
Which leaves us with this final provocative thought for you. Given the intensifying fiber competition right in their backyard, and the enormous cost of maintaining this high-performance network that needs to support customers chewing through 800 gigs of data every single month, does the potential long-term value they get from turning a temporary free wireless customer into a converged paying customer, does that truly outweigh the huge risk and cost of keeping broadband ARPU basically flat, maybe even declining, for over a year? Something for you to definitely chew on as you watch their next moves.